Hello, guys. Good day and welcome once again. Okay, so today we are going to be talking about the concept of liquidity in Forex. Okay, you may have been wondering, may have been asking, what is liquidity? What is it all about, and how does it benefit you as a trader? Okay, so today we are going to be taking a dive into liquidity, the concept of liquidity. So strap your seatbelts, let's dive in. Okay, so what is liquidity? Okay, liquidity in Forex refers to the ease with which a market can be traded without significantly impacting its price. Okay, a market with large numbers of buyers and sellers at any given time is considered highly liquid. Now, when a market has a high number of buyers and sellers in the market at any given time, that market is said to be highly liquid because of those small price movements. When a market has when the market is able to attract interest from a large number of market participants, that market is said to be highly liquid. And those activities from those market participants is what makes that market liquid. So your individual trade does not significantly affect the price of the market. Whereas in an illiquid market, which is the opposite of a liquid market, an illiquid market is a market that lacks liquidity. What it means is not so many people are interested in that market. So you don't get to see all those small price movements in an illiquid market. Okay, an illiquid market is a market that is the opposite of a liquid market. Okay, so let's continue. Now, you may have heard of the word liquidity zone. You may have heard of the term liquidity zone in your trading career before. So, what is a liquidity zone? What is this zone all about? Now, these zones are areas where trading is most active and they are marked by high trading volumes and where buy and sell orders are densely accumulated. So as we've established before now, we said a liquid market has a large number of market participants interested in it. So when market participants are interested in it in their numbers, let's say there's a big so much interest from participants on a pair, on a single pair. Now, in that pair, you get to notice that there are regions where large number of trades are being accumulated. Okay, there are some regions where you could anticipate a market to to let's say buy or sell in so region. So in those regions, trades are being accumulated, orders are being accumulated in those regions. So those regions, liquidity zones can be found in those regions. So examples of liquidity zones are your demand and supply, your support and resistance. Why is this so? It is so because in those regions, there is a high interest from buyers and sellers in those regions, and they tend to stack up market orders in those regions. Example, you get to see regions where you could anticipate a trader might set his stop loss, a trader might take his entry, a trader might also set his take profit, or you might anticipate a sell stop, buy stop in those regions. So in those regions, orders are densely accumulated in those regions because of the interest traders, big money movers, the hedge funds, the central banks, and the likes, the interest they have in those regions are what makes it a liquidity zone. Okay, so for the purpose of making this video a very short and a bite-sized one, we're not going to be doing technical analysis today. Okay, but we're going to make a separate video where we're going to analyze and we're going to identify, analyze, and talk more on the liquidity zone and liquidity using the charts. Okay, so now what are the benefits of liquidity zones? You may be asking, why is it important for me to know or to understand liquidity zone? Why is it crucial as a trader to have an understanding of how it works? Okay, now trading in a liquid market ensures quick and efficient transactions with tight spreads and lower transaction costs which enhances overall trading efficiency and reduces risks. Okay, so if you have been trading before now, you may have noticed that some pairs, some market pairs have higher spread charges compared to others. Some have very small spread charge. In some cases, you might be charged 20 cents for spread charge, while in some pairs you might be charged up to even 80 cents or $1 or $2 for spread charges. Okay, so it goes like that. Now, when you're trading in a liquid market, especially when that market is in a liquidity zone, spread charges tend to be narrow in those zones, meaning you can execute that trade with minimal cost. The cost of executing that trade becomes very cheap, right? Okay, so now liquidity zones also offer several benefits for traders, including the ability to identify potential market movement and reversal. Now, while you're trading in a liquidity zone, you could easily spot a potential reversal due to those stacked up orders we talked about earlier on. You could easily tell where those orders are being stacked and what price might do in the nearest future, where price might be heading in the nearest future. These are the advantages of liquidity zone. You can add a liquidity zone to your group of strategies you use to identify market behavior. Okay, so by utilizing these zones, traders can refine their strategies and make more informed decisions. So when you have an idea of where these orders are being stacked, you get to understand what the big money movers are doing. You get to understand what price might be doing in the nearest future. Okay, so what is the role of bid and ask price in identifying liquidity zones? Bid and ask price indicate a market liquidity because a narrow spread indicates a very liquid market, which is often associated with liquidity zones as a result of locations with continuous low bid and ask price may indicate considerable liquidity. Okay, I'll go over that again. Bid and ask price indicates a market liquidity. Narrow spreads indicate a very liquid market, which is often associated with liquidity zones. As a result, as a result, locations with continuous low bid and ask spreads may indicate considerable liquidity. What this means is, as we were saying earlier on, when bid and ask price, when the spread charge is narrow, when it's the space between the bid and ask price, the green line and the red line on your chart, the space between them is called the spread charge or the bid and ask spread. So you can call it the bid and ask price. The spread between them, the bid and ask price. Yes. So you can call it the spread charge. When that spread charge is very, very narrow, when the bid and ask price come very close to each other, the spread charge tends to be very, very cheap. It then tends to be narrow. Okay. Now, when that occurs, it means there's a high number of buyers and sellers pushing that market. Okay, and now when you enter a market with a narrow bid and ask price, it costs you less to execute that trade. Okay, so that is one other way of identifying a very liquid market. Okay, so what is the meaning of liquidity sweep? This is a very, very controversial topic in the forex world. Okay, now liquidity sweep, also known as market manipulation. Okay, some call it market manipulation because it is a market scenario which large institutional traders purposefully move the price of a pair or of a market to a particular level in order to cause large number of pending orders to be triggered, such as stop loss, buy limit, sell limit, etc. Okay, so you must have heard of the term stop hunt. Okay, now this is also called stop hunt, liquidity sweep, or liquidity grab. Some call it liquidity sweep, some call it liquidity grab, some call it liquidity um, stop hunt. I mean to say. So what this means is these markets, these big market players, they know where they anticipate where retail traders or small traders set their stop loss. And in order for them to get an advantage in the market, in order for them to enter the market with a discount price that that would cost them little, and to avoid slippage, they know how to push the price lower, no, or higher depending on the trend. They know how to push the price to a point where they can stop small traders out of the market by hitting their stop loss before before pushing the price back to its original direction. Okay, so what these big players do is they aggressively push the price against its original direction to hunt those stop loss. After those stop losses have been hunted, and most majority of, especially those traders who trade with a tight stop loss. So if you're a trader and you trade with a tight stop loss, just know that you're definitely going to suffer from liquidity sweep often in the market. So it's advisable to give your trade a breathable stop loss. Okay, not too large. At least it should follow your risk management principle, but it should be breathable, right? So you can avoid liquidity sweep. And also, your entry is very, very crucial in Forex. Okay, your entry, your stop loss, and your take profit. These are very, very, your entry, your exit, and these are very, very crucial things to take note of in the market while trading. Okay, so how does it work? How does liquidity sweep work? When price reaches a liquidity zone, e.g., a support or resistance, these large traders places huge orders to aggressively move the price through that level, causing a chain reaction of stop loss orders and other pending positions to build momentum in their desired direction, after which price reverses back to its original direction. So as we said earlier on, these big market movers, they are the ones with the huge funds. They are the one with the large capital, so they can move the market as they please. So for in order for them to enter the market with an advantage, they know how to enter orders that will push the price lower or higher to their most preferred entry position. Okay, and this is what leads to stop loss hunt, because by doing that, other small traders will be stopped out of the market. Okay, so that is it. Okay, so how does this affect small traders, retail traders? How does liquidity sweep affect them? Retail traders with stop loss orders placed near liquidity zones can be adversely affected by a sweep, potentially leading to losses if their orders are triggered prematurely. So just as we mentioned earlier on, let's say you execute a trade, you buy a pair and you put a very tight stop loss, let's say a $2 stop loss, and the market is very liquid, meaning it's going to make a lot of movements, a lot of movement. Okay, so $2 stop loss within a very short while, price can stop you out. Okay, I'm not saying $2 stop loss is not fair, but depending on your entry position, you should give your entry position a breathable stop loss. Be mindful, your stop loss should also follow your risk management principles. Okay, it's very, very important as a trader. You have a trading plan, you have what you want to achieve. Okay, you should have a goal and a well and clean written trading plan. Okay, so with that, if you can actually follow your trading plan, you are good to go. I mean, you put yourself in the right position to do better in Forex. Okay, why is market liquidity important? Okay, so a less liquid markets are generally seen as higher than as a less liquid markets are generally seen as riskier than highly liquid ones. Okay, a liquid market tends to make lots of small price movements as the high number of trades impacts its price at any given moment. An illiquid market, on the other hand, might suddenly leap from one price to another thanks to a single deal. Now, what this means is in a liquid market, we said a liquid market has a lot of market participants present that are participating in that pair. But in an illiquid market, it means there is no much interest from traders in that pair. So price is not always moving, just like in a liquid market. If you go to a liquid market, let's say you go to the 5 minutes or the 10 minutes or 15 minutes time frame, you'll see price doing that up and down movement, and going on its own. Compared to an illiquid one, price is stagnant. After a while, you just notice that it leaps from one position to another, and it stays there for a while. And before you know it, it leaps from one position to another. These leaps are as a result of huge orders, huge deals that are taking place in the market. The more market participants tend to show interest in that pair, the more liquid it becomes, the more small movement it tends to make. Once you take away liquidity, it stops moving continuously, it stops moving with those, it stops giving those small moves, and becomes less liquid. Okay, now in that type of market, you should not be found trading in such market, because once price goes against you, it's usually not a good thing to behold. Okay, so with that, we've come to the end of today's presentation. I do hope you managed to get some value. Okay, so if you enjoy what we do here, kindly give us a like, subscribe to our YouTube channel to get more educative content like this bite-sized forex tips to help you become a better trader, put you in a better position to trade well, inform you, and so on. So thank you and have a wonderful day. Okay.